Okay, I'm going to take our conversation forward. It gives me great pleasure to bring on board Charandeep Singh, founder and managing director of Girik Capital, and then you've got Varun Daga, his co-founder. They both join us live. Good morning. Thank you both for joining us. Different backgrounds, so clearly you've not started coming to office.
Well,
चालू कर लो भाई. चालू कर लो. It's everything is normal. Even we've come back to our studio.
You're putting us on the spot. No, but we are back in office. I just decided to do this from home today because I have a better background, better sound, better acoustic, all of that. Yeah.
Well, we've started this interview on a chirpy note, but if you look at the screen, are you getting that same level of optimism? Because it's been a heck of a volatile March.
I think Nikunj, it's right. It's been volatile, but it's probably been volatile since October, if you've seen it, right? If you see, markets sort of topped out in October, and a lot of the stocks, leaders of the market sort of made a top in October, and haven't really performed or added value to portfolios since then. So this has really been a phenomenon for the last 6 odd months. And I think the news kind of followed the bad news related to the war, related to commodities inflation. But the markets were already telling us something was coming. I think, maybe hopefully it's the end of the volatility soon, not the beginning.
For markets to go higher, either news has to change on the geopolitical front, let's say on the energy front, or prices have to become attractive. That's how markets, they typically bottom out. Just to draw this point for our viewers, Varun, is that markets bottomed out even at the peak of COVID crisis because prices had fallen to real historic lows. We are not there yet in terms of a turning point for the news or pricing in terms of the underlying stocks. So why do you think, or why is Charandeep of the view that we are nearing the end of the volatility?
See, a good point, Nikunj. Actually markets, they climb the wall of worry, right? So if you see in terms of the worry, we have all the bad news around us, inflation, war, and the earnings are, people are shocked that how the earnings are going to be. Multiples are high in large part of the market. So, I think what can happen here, and the way we are looking at it, we are seeing the leadership churning around. So, what we saw in the last decade, where you had financials and consumer stocks lead the bull market, it's very different this time. We are completely seeing that leadership move to commodities, move to IT companies. So I think where everybody is focusing may not be the place to focus, right? So I think one needs to change the way they look at these companies and probably start looking at some of the old economy and the metals and the oil companies. So it could be interesting. And frankly, they are not expensive at all, right? So it's just that nobody has owned them for the long time, and it'll be tough for people to analyze it and in fact convince their own mind that, oh, how can I own a metal company or an oil company? So it'll be interesting to see what does well.
So Varun, you have metal stocks in your portfolio. We've discussed this. Why are you looking at now increasing your exposure to metal stocks, or are you looking at retaining your current exposure?
So, sorry, you were saying something, Nikunj?
No, I'm saying that metal stocks is something which have been part of your portfolio, and given that right now there is an energy shock, there is greenflation, new capacities will not get added, does it make sense to ride this entire uptick in metal prices?
Yes, absolutely. So, I'll tell you, it's so funny that the metal stocks came up on our screen and we spoke about this, right when the COVID hit, and as the markets were coming back, we saw that leadership in metal stocks. And, it's been over a year and a half. And even this time, they continue to lead. Of course, there are a lot more reasons and the fundamentals have played out. But it's very clear that the rally is continuing. The fundamentals are getting stronger. And I still feel that there is a lot of doubt in the analyst's mind or in the people's mind on the street about these companies, because they feel it's just temporary. The prices are going to come off next year. Everybody's projection for all the metal companies for FY23, FY24 is just going down. assuming that the prices are coming off for sure, right? But if that changes, and that's what we are playing for, then I think there could be a lot of surprise on the upside for some of these companies, even from here.
Sure. Varun, also wanted to get your thoughts in on some of the private banking names. I mean, I know for a while now you've been bullish on market consensus calls like ICICI Bank as well as SBI. But is there reason to believe that perhaps Kotak and HDFC Bank could at least attempt a catch-up with what ICICI Bank as well as SBI have done in the past, especially now with the RBI removing off, the big overhang on digital for HDFC Bank? Could they really play catch-up, or do you think the market was right in their treatment towards SBI and ICICI Bank on one hand and HDFC Bank and the rest on the other?
I'll let Charandeep answer this because he has a lot of clear views on the financials. So,
sure, Charandeep, go ahead.
Hi, good morning. No, you're probably right there that HDFC Bank does have some catch-up to play. And I think the view there generally is that the stock took a hit for the last couple of years and it underperformed peers because it had issues with the RBI, right? So that was a huge hit to their fee income. So yes, in that sense, in the near term, they should come back. They should gather some market share. But also with HDFC Bank, there have been leadership changes, and you know what that can do to stock prices because it takes time for new leadership to also prove their mettle. So I think the outcome will really be determined by how their earnings growth shapes up. And so far, it's been good. There have been really no issues. The one point that I'd like to add over here is that there's a lot of digital disruption going on in the universe. You have guys like Google Pay, Phone Pay now controlling the payments environment. Can that hurt the fee income of all these private banks? That question is still to be answered. And that is a genuine threat to the longevity of these franchises. I don't believe that, these franchises are going anywhere. But I think the earnings acceleration, especially on the fee income side, may take a hit. It may not be as much as people anticipate right now. And, that fee income gives so much velocity to the earnings and so much extra ROE that if that doesn't come through, it's not such a good thing for the stock price. So in general, one has to watch out for this as to how it shapes up.
I don't know which one of you would answer on this one, but Nikunj and I always joke about how many of us are wearing Zara clothing and why Trent is trading at the 70 PE multiple that is. Well, will it continue to cherish this high PE multiple?
Yeah, I can take that, and Varun can jump in. I think that, when you look at the consumer segment in India, there's a lot of stocks trading at that PE multiple. You find generally the whole basket has traded very expensive for the last 3 or 4 years. There are probably reasons for that. Although, we've generally stayed or shied away from the consumer basket because we couldn't justify those multiples with the kind of growth that was being offered to us. For us, generally, we are okay to pay a multiple and we're okay to pay up for a franchise if there are 2 good reasons for it. One is there is a leadership in the franchise. They're genuinely out there, number one, at what they do. Their management teams are secure and brilliant at what they do. The execution has been phenomenal. And the second very important component is earnings acceleration. So you should be seeing 60, 70, 80% kind of earnings growth over the next several years, which should surprise the street. If you remember the last time we saw this with a consumer company, that was probably DMart after its listing. The earnings went berserk. And then what happened to the stock price? It went up like 5-6 times after IPO, which everybody thought was also very expensive. So when you look at something like Trent, the execution has been phenomenal. They've been slow and steady, and they seem to have cracked their West Side and Zudio models. So when we looked at it recently, we said, look, this looks quite appealing. And it has what most other consumer companies don't have in India, which is highly accelerated earnings growth with a leadership franchise. And there don't appear to be many threats to this leadership. So this is why we think that it trades where it trades. But also remember one thing, if the earnings triple over the next 3 years or 4 years or 5 years, whatever that period is, you pick the period, there is a good chance that this multiple won't look like it's looking today. And that generally happens with high growth stocks.
Of course, it'll be interesting to see what happens with Trent once the Tata Super app is, of course, launched as well. We do understand the soft launch of that is on 8th of April. Good morning, gentlemen. It's Nantara who's now also coming in. You both recently in an interview said that you're sitting on more than average cash, and that's after cashing out of stocks that didn't do well or that were old winners. Can I ask you which these stocks were and how you're deploying that more than average cash?
You want to take that, Varun?
Sure. No, so, I'll tell you, we are, for us, creating cash is just a measure of risk control. We are, I think one thing very important is there at Girik is managing risk. And, that's one thing we do well, we feel. And so what we've done is, wherever we saw risk, I'll give you an example, and we've talked about this, we like the stock, but we did get out of it. It's Zomato. And why did we get out? Because we saw there was risk. We saw NASDAQ was, it was really punishing some of these high valued IT companies. We did own it. And the reason for owning it, we've owned DMart when it was very expensive, it did very well. So we are not shying off buying some of these winners, which we believe can become big. But I think what we do very well is we manage risk. So when we saw that happening in the US, we realized that, and when the price started behaving badly, we started to realize that, okay, there could be trouble here. And we managed to get out very, very early in something like a Zomato. Having said that, it's not that we don't like the story, but we really believe that, we have to keep our conviction and our biases away. And when we are managing third-party money, we have to make sure that we put risk right on top. So that's one example where we exited and that created cash. Now, we are always looking for new ideas to deploy, right? So for us, creating cash is just a measure of risk control. And then we use that cash for new ideas as they come up. So for example, Trent was one idea which we thought that could be an interesting one, where most of the consumer companies are suffering. This is one stock which we thought that could have accelerated earnings for the next 3-4 years and a long tail of growth, and did very well in a bad market, which also tells us it also gives us a lot of early signs when a stock does well in a bad market. So that's when Trend came up, and we're always looking for new ideas to deploy in. So hopefully, as markets get better, new ideas, new sectors, new leadership will emerge, and we will be fully deployed.
Right, so Zomato became the sell and Trent became the buy in the recent reshuffle. And whichever of the two of you want to take it, the big idea right now, would it be around energy, just simply given the energy shock that we're going through? What's happening with commodity prices as well?
Sure, I think I'll take that. So yes, I think it's a very, very real trend, and it's again a very, very underowned theme. I think people are still in the financials and in the consumer. A large part of people's portfolio is just in that, and we really believe that the leadership is shifting towards the oil companies and the metals companies, the commodities as a basket as a whole. And we are really looking for some of these names, So we think it could be a very, very interesting place, because the earnings of some of these companies is really, really, they can really explode. And when the earnings come, people will realize how cheap these stocks are. And everybody worries about what would government do, whether they will intervene. What are they going to do? People are very scared of that, but we feel that I think the size of the earnings are so huge. Look at something like an ONGC. It could make it already makes about 10,000 crore net profit a quarter, and it could, with oil prices higher, it could do a lot more. So we are studying some of these companies, and I think the most important thing here is to keeping our minds open, right? The biggest challenge is our own mind, because we've not seen them do well for a very long time. But just remember, in 2007, the oil and gas basket in the index was 25%, right? And if you take out the other businesses of Reliance, Geo, and retail, the oil basket would be about 4 or 5%. So it's really got become very less, but it can come back. So ONGC back in 2007, I remember it was about 7.5% of the index. Today it's 0.75%. So things can change, and it could be a very interesting space to look for.
What are you not likely to sell? There was a time when the general consensus was that you don't sell HDFC Bank because it will be a resilient outperformer. So which are some 2-3 names which you would say, look, they're the core of my portfolio, and I'm not going to be selling them even if crude goes to $150.
So Nikunj, I think we don't have that thought, as a philosophy, as a thought process. We are not married to anything, right? And I think that's our differentiator. We will not say that, okay, we'll not sell an HDFC Bank or an ICICI Bank. We might like it today. We might not like it after 1 year. So the thing is, Nikunj, that, leadership can change. We've seen from 2004 to 2014, Hindustan Lever did nothing. ITC for the last 5-6 years has done nothing. So, a lot of times great companies can become underperformers for a very, very long period of time. So I think for us, it's very important that our portfolio should make money at all times. And that's the promise we have given to our investors, that their portfolio should be working at all times. And we will be in areas and spaces where we can make money, where companies are run by good promoters, where stocks are liquid, and we should be able to manage risk at all times. So I think we are not in the basket of these are the 10 companies or 5 companies you have to have in the portfolio, and how can you do without them. We are alpha managers, and I guess we don't like that hugging the index kind of thought process. It's okay if we underperform for a period, but we believe our systems are robust enough to get us in the right place at the right time. So that's what we feel.